Hello, everybody. Thank you for joining me today. My name is Wade Hansen. I am a member of Profiting with Forex. I helped write the book with John Jagerson, and also we have created a companion website, PFX Global. For any of you who have any questions during the presentation or after the presentation, feel free to send me an email anytime. I'm happy to chat and see if I can help you at all in your Forex trading. And again, I'm really glad to be here with you today. We're going to be talking about something that for me is a foundation level aspect of currency trading, and that is combining fundamental and technical analysis. And this is something that is really quite important to me. I'm quite passionate about it, and I'm excited that you've joined me today to talk about this. And I'd like each of you to ask yourself the question, what type of a trader are you? Do you feel that you are a fundamental analyst, or do you feel that you are more of a technical analyst? And I would be willing to bet that most of you probably associate yourselves more with being a technical analyst, and that's just the nature of how the forex business has developed and how it is also marketed. If you go out and you look on search engines and around the internet for different information on currency trading, you'll notice that a bulk of the information has to do with technical analysis, whether it's a trading system that is promising that you'll make 1,000 pips a week, or whether it's a trading system that promises you'll never lose more than 2% of your account, or whatever the claim is out there. Most of it revolves around technical analysis, and that's okay. Technical analysis definitely has a huge role in our currency trading, but what often gets overlooked is fundamental analysis. And my point in this whole presentation, as the title would suggest, is that we can combine the two. We don't have to view ourselves as mutually exclusive to either fundamental analysis or to technical analysis. We can use both hand in hand in our currency trading, and really we give ourselves a leg up when we do so. So as we're going along through this presentation, please feel free to type in any questions you have as we're going, and I will be jumping back and forth between my presentation and answering the questions to make sure that this is time well spent for you. So what I want to start with is taking a look at what is fundamental analysis, because we hear these terms out there in the marketplace quite frequently: fundamental analysis, technical analysis, but what do people really mean by it? And for me, when I talk about fundamental analysis, I am simply talking about analyzing the underlying forces that make a currency pair move. That's all I want to know. If there's something out there that is going to move my currency pair that I am watching, I want to know about it. Because if I can know about it ahead of time, I can take advantage of whatever that movement is going to be, whether I'm protecting my current trade that I'm in or if I'm looking to get into a new trade. I can know what's coming and take advantage of that. Now, I put down here another little tagline. It's all about supply and demand. And really, that's true. As the forces of supply and demand change, the value of the currency pairs that we're watching also changes. And so that's what we want to be looking at. Now, when we talk about fundamental analysis, there are quite a few things that we can be looking at. There is fear in the marketplace. There are interest rates, news, bond yields, intermarket analysis, and commitment of traders, or COT report. Sorry, oops. I've got to go back in and fix that formatting. Sorry about that. I have a little bit of a perfectionist problem there. It's the editor in me. So let's start here and talk about fear in the marketplace. And I know when I talk to a lot of people about this, they say, well, how is fear fundamental in the marketplace? I don't understand what you mean. Well, as you look at the global economy and you look at where large banks have their money either invested themselves or if they have loaned it out to other people, where that's invested, where large hedge funds are invested, where central banks diversify their funds, you'll notice that funds are dispersed all over the place, whether they are in global stock markets, whether they're in global bond markets, whether they're in real estate. They're all over the place. And as fear in the marketplace heightens, as people get scared that they are going to lose money in some of their investments, they start to look around at where their other investments are to make sure that those ones are taken care of and they're on a solid foundation. And the past 8 months or so, we've seen a great example of this where fear, when it does come into the marketplace, and I'll make the caveat that it's not always in the marketplace. We go for long stretches of time where fear doesn't play a role in the marketplace at all. People are confident, they're investing, economies are growing, things are going great, and people really aren't too afraid. But when fear does creep back into the marketplace, it trumps every other piece of fundamental information out there. And a great example of this, I want to switch over to my charts here. And I'm going to pull up a chart of the dollar yen. And on top of this chart, I have overlaid an index. It's the Chicago Board Options Exchange Volatility Index. You'll also hear this referred to as the VIX, or the VIX Index, or the Fear Index. And what it is measuring is its put volume on the CBOE, and especially those stocks that have to do with the S&P 500, and it's showing how fearful investors are. Now, so we look back here in July. For all of you who were trading back then, you remember that news came out of the subprime meltdown, the credit crunch, everything that we've been talking about for the past 8 months started at the end of last July. That's when the news first broke, and you'll see here that the yen has been gaining significant strength ever since then. We've had a few ups and downs along the way, but the yen has been gaining strength since then. Now this black line behind here is a chart of the VIX, or that volatility index. Now when this chart goes higher, that means fear is increasing. Fear is getting higher. And when this chart gets lower, fear is getting lower. Now you'll notice back here at the beginning of the chart, fear was flat. It was low. People were quite complacent. Down here in February, fear was really low. And people were happy with what was happening in the global markets. They weren't worried too much about where they had their money diversified. They felt pretty good about it. And then suddenly, bam, right here at the end of July, the beginning of August, fear went berserk. And everybody started looking around at it was these subprime loans that really started it all, and large banks and other financial institutions had all invested in CDOs, or collateralized debt obligations, that bundled all these subprime mortgages together. They were starting to default. People didn't know if they were going to get their money out, and as they started worrying about their money here, they started looking around and saying, well, boy, where else is my money exposed? And for years, people had been borrowing money in Japan at low interest rates, almost 0% at some points, and right now it's only 0.5%, and they've been investing that money all around the world. Whether it's been in Great Britain or Australia or New Zealand, they've been borrowing in Japan and investing it elsewhere. Well, when they saw risk levels starting to increase, they said, uh-oh, we better pull our money back out of those areas and repay our debts in Japan. Now, when they started doing this, it started moving the value of the Japanese yen, because suddenly there was this huge increase in demand for the Japanese yen. And so people started moving their money back into the Japanese yen. And you can see here that as fear increased, it has an inverse correlation with the dollar yen. Because the yen is the quote currency in this pair, there's an inverse correlation where every time you see fear spike, you see the yen gain strength, and then fear kind of subsides a little bit, and as it does so, the yen started to lose a bit of strength here. Then as fear started to increase again, the yen started gaining strength again. So we're right here. Fear has been you could say making a triple top here and is as high as it's been for a while, and the yen has stabilized. So we may have found a bottom here, but it's interesting to see that regardless of everything else that was happening fundamentally, Japan didn't raise interest rates. They still have super low interest rates. Their economy isn't doing any better than the U.S. economy. So, that doesn't account for the reason why the yen has been strengthening so much. Japan is probably impacted more adversely by the increasing price of oil and other economies and other commodities than the U.S. is. So that wouldn't account for the yen strengthening so much. Really, it was fear. Fear played the trump card of moving the fundamentals. And so as we look at this, we say, okay, fundamentally speaking, when fear comes into the marketplace, it trumps everything else. It takes over, and regardless of whatever is happening elsewhere, fundamentally, fear is going to take control. So go back to presentation here. And the next is interest rates. Interest rates really do drive the currency markets. The economies that have higher interest rates tend to do better, and their currencies perform better than do the currencies that come from economies with lower interest rates. And going back to the charts here, a great example of this is the pound yen. I'm going to switch here to a weekly chart so we can get a nice long-term view here. And I'll go out a little bit. So if you look at this, interest rates in Great Britain have been somewhere between 4.5% to 6% during this period, while interest rates in Japan have been anywhere from 0% to 0.5%. And as you look at this, you can see that there's a nice clear uptrend that shows that this interest rate differential that led to a lot of carry trades, and again, for those of you who may not be familiar with the term carry trade, a carry trade means that you find an economy with low interest rates that you can borrow money from, like Japan, and then you find an economy with high interest rates where you can invest the money, like Great Britain, and you keep borrowing money at low interest rates from one economy and putting it into the other economy with high interest rates, and you make the difference. And that has started to unwind a little bit here recently, but for the longest time, this currency pair just marched higher and higher and higher and higher and higher. And that was driven primarily by the interest rate differential. And as you look at long-term charts of most currency pairs, you can see that the long-term trends are strongly influenced by that interest rate differential. So it doesn't necessarily always impact the day-to-day movement of the currency pair, but over the longer term, those trends that form, interest rates play a huge role in what's driving the currency pair. And so as you are conducting your fundamental analysis, you want to keep an eye on currency pairs and their interest rates to see what's going on. The next is the news. The news is certainly something that can change the direction of a currency pair, or it can increase the speed at which a currency pair is moving in its current trend, depending on what happens and what news comes out. And as you are conducting your fundamental analysis and you're watching the news, you're going to be looking at a lot of different calendars out there to see what economic announcements are available or are coming out during any given week. I'm pulling up on our website at PFX Global, we have a calendar where we'll walk through the weekly news events, and it's great to know what numbers an economy is going to be putting out. Like today, we had the Bank of England put out their Monetary Policy Committee meeting minutes, and this is a great tool for us to look at and read and see what the Bank of England is watching, what they're thinking about, and again, it leads back to what are they going to do with their interest rates? That's what everybody's concerned with. Whether we're looking at inflation reports, whether we're looking at their meeting minutes, whether we're looking at employment data, we are wondering what these central banks around the globe are going to be doing with their interest rates, because we know that interest rates drive the long-term trends of these currency pairs. So this was an interesting one for us. Recently in the U.S., building permits and housing starts have become more and more important because of the subprime meltdown and the slowing economy in the U.S., the credit crunch. It's been interesting as the Federal Reserve has been lowering interest rates. It's been nice, but that credit hasn't been filtering down to individual home buyers here in the U.S. because the banks have tightened their lending standards. They're not going to give the money out as freely as they have in the past 4 or 5 years. And so as we're watching this, building permits and housing starts a couple of years ago didn't really mean much to your average currency trader because those announcements wouldn't have done anything to the market. But lately, because of the fundamental situation that we are in the global economy, and with housing worries and with a credit crunch, people are starting to pay more attention to these numbers. And then we also have the FOMC meeting minutes, which is just like the MPC meeting minutes, just for the US. But as you look at these news announcements, it's one thing to say, okay, here's what the announcement is, and I'm going to click here and expand this a little bit for building permits, and we'll see that there was a forecast or a consensus number of about 1.05 million building permits that were going to be issued during January. And as we look at this, we say, okay, well that's nice. That's what everybody's expecting. And so that is where the currency pairs have positioned themselves. And as they go toward that number, if when the announcement comes out that the number is similar to this forecasted number, your currency pair is not going to move because everybody has known that that was going to happen. Imagine that if you've seen any movies like Twister, that one was a long time ago, or any tornado movies. In the Midwest in the United States, they are during the spring and summertime, they have a lot of problems with tornadoes. As storms come up, they develop tornadoes, and they can be quite destructive. And imagine that you're on a farm out in the middle of the United States, and you see that there's a tornado warning coming. And the tornado warning says that the tornado is going to come through your hometown, and that you need to evacuate, get out of the way, so that the tornado, so that you can be safe, that you're not going to get wiped out by this tornado. So you pack up your family, you drive over to the neighboring town, and you plan on waiting it out there as the tornadoes pass through. Well, if the tornado passes through your hometown, then if you have driven away and you are in the neighboring town, you're safe, you're fine. You don't have to worry about the tornado getting you. And so you're not going to move from that spot because that's what you're expecting. But what if the tornado changes directions and starts coming toward the town where you have just gone to? Well, then you're going to try and get in your car and drive back to your hometown so that you can avoid the tornado hitting you. The same thing happens in the forex market. As a forecast or consensus number comes out, everybody starts positioning themselves to take advantage of that forecast number. We all want to be ahead of the curve. We want to be there before the news actually happens. You've probably heard the saying, buy the rumor, sell the news. That you want to act on the news or the rumors so that if they do indeed turn out to be true, you are in a position to take advantage of that. And so people in the forex market, they start to position themselves as those forecasted news events come out. And if the forecast turns out to be accurate, then everybody's happy, nobody moves too much. But if the forecast turns out to be wildly inaccurate and the number comes in greatly above that level or greatly below that level, then people have to scramble because suddenly the playing field has changed and they have to look and see what adjustments they have to make in their trading to make up for the movement that has happened before and the movement that is now happening because of changes in the marketplace. And so, as you see, in the case of building permits, if suddenly we saw that there were a lot more building permits issued than most people were expecting, that would be good for the US dollar because it would show that the US economy was getting stronger and more people were starting to build homes, and we could stop talking about recession and we could think, okay, more and more people are starting to build homes, we're going to make it, we're going to be okay, and that should boost the value of the US dollar. On the other hand, if the number came in dramatically lower than everybody had anticipated, people would say, wow, things are worse than we thought. We need to do something about that. We got to sell more dollars. And so they will start moving, and whether you're trading, let's say you're trading the euro dollar, it's going to send the euro dollar higher because the dollar appears to be getting so much weaker because the US economy doesn't appear to be doing as well as everybody had thought it was doing. So as you're looking at the news, it's important to know not only what news announcements are coming up, but it's also important to know what you're going to do around those news announcements. If the news announcement comes in right as forecast, great, you don't have to do much. But if the number is dramatically different, either higher or lower than the forecasted number, then you're going to have to take some action to either protect trades you're in or potentially enter some new trades. So let's go back now. To presentation here. We've talked about news. Bond yields are one thing that I wanted to talk about here. They are similar to interest rates. And as you're thinking about other participants in the marketplace, you have to think about them just like you think about yourself in your investing. When you're investing in the forex market, or if you're investing in the stock market or in the bond market, your goal is to make as much money as you can. Now, certainly you want to have some protection. You don't want to be too aggressive or take too many risks, but your ultimate goal is to make money. That's the reason we invest. There's no real altruism in it. It's a selfish desire to make more money, and that's okay. You know, we're trying to make our money work harder for us. And knowing that about yourself, it's important to recognize that in everybody else who's in the market. They are all in it for the same thing you are. And so as you look at different places around the world where if you were a large multinational bank, or if you were a government that was working on diversifying your reserves, or if you were a large hedge fund or a large company, as you're looking around the world for places to put your money, you're going to be looking for places with the best yields or the best return on your investment. And different bonds around the world that are issued by governments, bonds that are issued by the US government or the Japanese government or the British government or the German government or the Australian government or the New Zealand government or the Canadian government. As you're looking at those bonds, you want to see which ones are paying the best yields, and that is going to drive investment into those bonds. And as investment comes into those bonds, demand for the currency that that bond is denominated in is going to go higher. For example, if the gilt in the UK is offering a nice yield, then people are going to want to buy those British bonds, and it's going to increase the demand for the British pound, which should drive the value of the British pound higher. And so I'm going to click back here again to our site, and I'm going to pull up one of our currency dashboards, show you what I'm talking about here as this loads. And the top chart here is the interest rate spread. You can see that the interest rate spread is favoring the euro now, as it was favoring the dollar for a while. But if you scroll back up here, you can see that interest rates in the from the ECB are at 4%, while interest rates from the Fed are still only 3%. So there's that differential. But then this is the chart I wanted to take a look at, is this 10-year yield spread chart. And I'm going to click on this to bring up a bigger version. And this is the difference in the yields between the US 10-year note and the German Bund. And what we're looking at here is you can see that around these peaks that the yields on the German Bund were higher than the yields on the 10-year note, and which should be stronger, lead to a stronger euro. And so as we were climbing up here, we saw this trend increasing and increasing and increasing, and then it's been decreasing a little bit. But it's one more fundamental factor that shows us, yes, the euro, fundamentally speaking, is still a little stronger than the US dollar. So I'll click back here to the presentation and move on to intermarket analysis. I also wanted to just check and see if anybody has any questions. Not seeing any. Please feel free to shout them out if you've got some questions. So the next is intermarket analysis, and to take a step back here and look at all these different things that we've been looking at. We've been looking at fear, and we looked at a volatility index for U.S. stocks. We've been looking at interest rates, news, and the calendars that we use to identify the important news announcements for the week, bond yields, intermarket analysis, and we're going to be looking at the Commitment of Traders report. There are a lot of different things that fall under this umbrella of fundamental analysis. And it's not something that necessarily takes a lot of analysis every day. Certainly, as different news events come up during the day, you'll want to be aware of any big announcements that are going to be happening each day, but really you can monitor those in 5 or 10 minutes a day. Interest rates, they don't change that frequently. Unless you have a surprise rate announcement like we had a month ago from the Fed, we know the days that the Fed or any other central bank is going to be announcing their interest rate decisions. So, that doesn't change too frequently. Fear, it's been something that we have been paying attention to for the past 8 months or so, but it's not something on a day-to-day basis we say, okay, well, fear levels rose 0.6%, and so we know that that's going to move the yen down another 86 pips. It's none of this is that precise, especially in the trading that we are all doing as retail traders. What we're trying to do is to get a big picture of what's happening out there. For fear, we want to know that fear has been increasing and it is remaining high, and that's really about as much as we need to know for us to effectively utilize that information when trading any currency pair that has the yen involved with it. Interest rates and these other things that we're watching, it's something that we can check on, but we don't have to spend our lives analyzing it, crunching numbers, trying to figure out exactly what currency value is going to be associated with a 0.5% bump in interest rates. It's never that precise. What we're trying to do with our fundamental analysis is to identify longer-term trends and forces that are going to push us either higher or lower. So keep that in mind as we're going through this, and if any of this has seemed overwhelming or like it's a lot of information, just remember that the question that we're trying to answer is, at the end of the day, with the fundamental forces that we're looking at, is it going to be pushing the currency pair that we are watching higher or lower? That's really all that we're trying to answer here. And then, because we are combining our fundamental analysis with our technical analysis, then we can start to identify some more specific price points and price levels and identify the action that we want to take in our accounts based on what we see happening fundamentally and technically. So just a step back reminder on that of with our fundamental analysis, you don't have to feel like you have to be an economist or be able to calculate complex calculations. I don't. I am simply looking for the forces that are going to push my currency pair higher or lower. That's what I try and boil it all down to. So intermarket analysis, this is something we've talked about, I've talked about before on some of these presentations. And what that means is looking at what's happening in one market and how that may affect what is happening in the currency market. And a great example of this is I have a chart here of the Australian dollar, and over this chart I have put a chart of the price of gold, the gold 100 ounce continuous contract. And the Aussie dollar and gold have a positive correlation. That means as gold prices increase, the value of the Australian dollar tends to increase. As gold prices decrease, the value of the Australian dollar tends to decrease. Now, with any correlation, we always have to remember that it's just that. It's a correlation. It's not a direct cause and effect that we can count on. Every time gold prices go up, we know the Australian dollar is going to go up, and every time gold prices go down, we know the Australian dollar is going to go down. It doesn't work quite that precisely, but it's pretty close, and it can give us a good idea of where those underlying forces are going to be pushing this currency pair. You can see here as the Australian dollar rallied, here the price of gold was climbing higher and higher and higher. Then as gold went into a consolidation period, the Aussie dollar went into a bit of a consolidation period, and then we've seen gold continue to rise, and we've seen the price of the Australian dollar continue to rise with it. Now, the reason that we see this correlation is because, again, as we're looking at fundamental analysis, it all comes down to supply and demand. And Australia produces quite a bit of the world's gold. And as we're watching this, as gold prices go higher, and people who are buying gold need to go to Australia to buy that gold. And the higher the price of gold, the more money they have to convert into Australian dollars to buy that gold. Because the gold's more expensive, they need more Australian dollars to buy it. And the more that they convert into Australian dollars, the more demand for those Australian dollars increases. And an increase in demand leads to an increase in value. And so we see the value of the Australian dollar climbing higher and higher and higher. So that's one example. Another commodity-related example is looking at the Canadian yen pair and the price of oil. Now, this one, we're going to see a couple of forces in here with the yen, like we talked about earlier, as we saw with the dollar yen, that as fear has increased, it has strengthened the yen against all of the currencies that it has been paired with. Now, it's strengthened more against some currencies than it has against others because there are more than just the fundamental factor of fear at play. But as we look at this, you can see that as the price of oil, which is this black line, has been increasing, and again, we're at all-time highs for oil right now, the value of the Canadian dollar compared to the yen has also been increasing. Now, as we look and take a step back fundamentally and say, well, why is that the case? Well, Canada is one of the world's largest producers of oil. And a lot of people don't realize that, but the tar sands up in Canada that they are extracting oil from are a huge oil source. Really, Canada is the second largest importer of oil to the United States, right behind Saudi Arabia. And so as we look at this and we see, okay, so high oil prices, usually as commodity prices increase, it benefits the countries that produce those commodities. And so since Canada produces a lot of oil and oil prices are going up, more and more people have to pay more and more money per barrel to buy that oil, and so they have to convert more of their money into Canadian dollars, which again drives demand for Canadian dollars, which increases the value of Canadian dollars. And we will see a couple hiccups here as as fear increased and it trumped the rising price of oil. Oil prices did decline a little bit here as well, but again, this is late July and early August when the news of the subprime worries really hit the markets, and we saw the Canadian dollar pick back up again here. And then the Canadian dollar has been losing some strength, but you'll notice that on its rebounds, those rebounds have coincided with the peaks of oil prices. So you can see that if you are watching oil prices, it can give you a good idea of some additional strength or weakness that may be associated with the Canadian dollar. And pairing it here with the yen, it really brings out a nice pronouncement in that, because while Canada produces so much oil, Japan produces virtually none of its own oil. It has a little bit, but virtually none of its own oil. And so Japan has to import most of its oil. And so since it has to import it, it has to sell Japanese yen to buy oil, whether they're buying it from Canada in Canadian dollars or whether they're buying it from Saudi Arabia in US dollars. They are increasing the supply of Japanese yen on the market, which decreases the value of the yen. And with an export-driven economy like Japan and the shipping costs of moving those goods around the world, they are heavily reliant on oil. So as higher oil prices are beneficial to the Canadian dollar, they're detrimental to the Japanese yen. And so as we look at this, keeping an eye on oil prices can help us trade the Canadian yen, just like keeping an eye on gold prices can help us trade the Aussie dollar. All right. And I had a note here. Let's see. Question on the bonds that we were looking at. Why do I look at 10-year bonds? What about 3 months, 2 years, 5 years? You can look at each time frame of bonds and notes to help you get an idea of what is going on. I like the 10-year note because it's right in the middle. It's something, especially right now, as the housing crisis has hit the United States. Housing prices are falling. People are having a hard time getting loans. Most mortgage dealers in the United States base their 30-year mortgage rates and their 15-year mortgage rates on the 10-year note. And so for me, it's one that I like to focus on. I do also look and see what is happening on the other parts of the yield curve and look at the shorter term debt instruments as well as the longer term debt instruments. So definitely you can look at each of those. And does the 10-year have a stronger relation to a currency pair? As I've looked at the relationship of the 10-year yields between particularly the euro and the dollar, it's been the one that's been most helpful for me. And then I've had some comments in here of different economies that produce a lot of gold or a lot of different commodities. And that's exactly right. As people talk about gold in South Africa, definitely. The South African rand is highly correlated with the price of gold, just like the Australian dollar is. And you'll find a lot of these different correlations around. An interesting one is the New Zealand dollar is highly correlated with dairy prices. As dairy prices increase, New Zealand is one of the major components of the New Zealand economy is dairy, and so as dairy prices increase, it's good for the New Zealand dollar. So there are quite a bit of of these correlations that are out there. I've only highlighted two in this presentation, but I'm glad that a lot of you are already aware of these and are aware of additional correlations that are out there based on whether it's financial instruments like the 10-year note, whether it's based on commodities like gold or oil, or whether it's based on fear, like we've seen with the yen and the volatility index. You can find these correlations out there that if you keep an eye on them, you can give yourselves a leg up in your analysis so that you can continue to move forward. Great questions and great comments. Thank you, everybody. Lastly, the Commitment of Traders report. This is an interesting one. What this is the CFTC here in the U.S., the Commodities and Futures Trading Commission, releases each week the positions that large institutional traders have taken, whether they are buying soybeans, whether they're selling gold, whether they are buying the euro compared to the dollar, whether they're selling the yen. We get a lot of information about this, and scrolling back here to what is fundamental analysis, it's analyzing the underlying forces that make a currency pair move. And really, large institutional traders are underlying forces that move a currency pair. And so if we can be aware of what's happening with those large institutional traders, we can, again, have an advantage in our trading of being able to ride along on their coattails and move where they're moving. I'm going to click back here quickly to PFX Global, and in our fundamental section we keep track of the Commitment of Traders report for each of the major currency pairs, and we're able to see as these lines move back and forth. I'm not going to really go into a lot of explanation about exactly how we use these right now, but as we see, pull up a bigger image here of the dollar franc, that these large institutional traders, their support for a particular currency pair or their interest in it moves up and down, which correlates well with the price movement. And as you watch this, and as you can see large institutional traders moving in one direction or another, whether they're buying a currency pair, whether they're selling a currency pair, you can say, okay, these large institutional traders typically don't change direction too quickly. Every once in a while they will if a major economic announcement comes out, but usually they will pick a trend and they'll start playing toward that because it takes them a while to get into a position and it takes them a while to get out of a position. And so if you can see which direction they're going, then you can jump on with them and move along as they go, because they're really the ones who are going to be moving the market. So if you want to know more about this indicator, you can come back to the website later. And great question here from Don. How relevant is the COT given the time delay? It's produced on a Tuesday and it's published on a Friday, and the next time that you can actually make a trade on that information is Monday. So really there's almost a week gap there. And again, it's something that is giving us information of the longer term perspectives of these large institutions, because they do have to take a while to get in and get out of their positions. They don't have the advantage that we do of being able to jump right in and jump right out 5 minutes later if it didn't work out for us. And so certainly it's something that if you are watching it, you have to say, okay, this is like any other correlation that we are looking at, that it's not going to be 100% accurate. Just like the increase in the price of gold isn't necessarily going to give us an increase in the price of the Australian dollar on the same day, but it can help point us in the right direction. It can give us the answer to that bigger fundamental picture of, is it going to push my currency pair that I'm watching higher, or is it going to push the currency pair that I'm watching lower? And really, you'll notice as you go back and look at the indicator that we have on our site, or just the raw fundamental data from the COT announcement itself, that traders, these large institutions, stay with their positions for quite some time in most cases. And it can help you in identifying when those trends are going to continue and actually strengthen, or if you see some weakness coming, it can help you in saying, well, it may be time to move up my stop losses here a little bit. Oh boy. I'll tell you what, when I get on these meetings with everybody and we get going, time just takes off. So I'll try and wrap this up here in the next couple minutes here, and I really appreciate your participation and your patience here with me. Moving on to what is technical analysis, it's analyzing price movements to identify your appropriate entry and exit points. And for me, it's all about support and resistance. And that doesn't mean necessarily my support and resistance lines that I draw, but I'm looking for those areas where currency pairs are likely to hit either support or resistance and turn around and start moving in the opposite direction. And you can identify that with support and resistance lines. You can identify that with technical indicators. There are a lot of different things that you can use in doing that. And again, as we step back and take a broad perspective of fundamental analysis and technical analysis, as we're looking at our fundamentals, and really we're trying to answer the question, is this going to move my currency pair higher or lower? Then once we answer that, then we can use our technical analysis to more accurately time, okay, fundamentally we think this currency pair should be going higher. Now let's use some technical analysis to determine when to actually buy this currency pair, or when to sell a trade that we're already in. So again, with technical analysis, support and resistance levels, and these can be hand-drawn, or you can use Fibonacci analysis, price patterns, you can use technical indicators. Really, it depends on your trading style and what works for you. I apologize, I don't have a lot of time to go into drawing these and identifying all of these, but I do want to show one quick example. Go back to the charts here. Pull up a chart of the euro dollar. Fundamentally speaking, for the past long while, the euro has been stronger than the dollar. And as I zoom out on this chart, you can see that reflected in this trend. It's been a nice long uptrend, but there have been times when the dollar has regained some strength. And right now we're in the middle of the big consolidation period. There's a lot of debate on which way the currency pair is going to break out of this consolidation period when it finally does break out. But as we look at this, fundamentally we have had the clues for quite some time now that this pair should be rising. And so that put us on the right track to begin with. And then we had to use some fundamental analysis of drawing some support and resistance levels, seeing where this trend may be going in the future to help us identify, okay, well, where do we want to go, and what do we want to do with this, and okay, if I enter here because I want to make a buy on this and I think it's going to bounce higher, where should I exit my trade? And if I am going to use some Fibonacci projections on here, how high do I think, if I buy here and I use a Fibonacci projection on this previous trend, hey, look at this, right at this first projection level is where it hit resistance. And knowing that that level was right there, I could have tightened up my stop loss as I was moving along through this trade. And then when this turned around and moved against me, bam, it would have taken me out at my stop loss. I would have made a nice profit on this trade and I would have been okay. So it's that combination of first finding out, do I think the fundamentals are going to push my currency pair higher or lower, and then using my technical analysis to come in and say, all right, here is where I see some of these levels forming. This looks like a good buy point for me. I have some potential sell points at other points along the way, and best acting on that information to get in and out. And it looks like I'll have to leave some of the discussion of that for a later presentation, or if you want to go back on the site here and look at previous recordings, I've talked about some of those. So I need to wrap up here, and there are a couple questions here that you have asked here. Please feel free to send those questions to me at my email address, again at wade@pfxglobal.com, and I will be back for 2 more presentations in March. I look forward to chatting with you then, and until then, keep profiting with Forex.